was less than a year after we shut the business down. Our potentially largest customer, he called us up and said, I've got your contract waiting now. One lesson we learned was the winners will stay alive long enough for good things to happen. And we didn't stay alive long enough.
As a value investor, you need to recognize that what's happened in the past maybe isn't going to give you superior performance over the long run. The challenge is determining what is the next thing.
And then they all get taken to the woodshed, obviously, because this now alien technology drops into Earth.
It means intelligence sort of gets commoditized. Dario's just been outright hostile, though, to say that this is going to kill jobs and we're going to have to go to universal basic income.
Prior industrial revolutions happened. We had a really step change in GDP. I don't know where GDP growth goes, but maybe we grow 5% every year for this foreseeable future.
This podcast is sponsored by the Capital Alliance Mastermind, a private community where fund managers share deal flow, build relationships, and grow together. Join the waitlist in the first link below.
Hello, everybody. Thanks for joining us again today. It's another episode of our Capital Alliance podcast. This time we have two good friends and very special guests, Mike Nicoletti and Jason Wallace, joining us from Topmark Capital in beautiful San Diego. As you can see the difference between their background and my background in New Jersey, where I'm sitting right now in my office. It's a little different. Probably similar weather, though. It's actually a nice day outside. I know Mike and Jason obviously they run this great fund, which they started in 2012 called Topmark, which has two funds that we'll get into. One of them focused on healthcare, and the other one sort of just more generalist focused, I guess. Is that the right way to think about the second fund? They're very thoughtful. They have a great podcast, which is called Telltales, that I would highly recommend, which they do with their mentor, Hunt Lawrence, who's a very successful investor and someone who has built a tremendous amount of value. I guess originally his thing was he was an energy investment banker, but he's full of wisdom. And also Mike and Jason were in Capital Alliance, where I've gotten to know them really well over the last year or so, are in Capital Alliance. And so yeah, we've gotten to know each other really well. They have really impressive and thoughtful commentary on so many things. I'd highly recommend you follow them and follow their Substack. So with no further delay, I'd like to turn it over to Mike and Jason. Thanks for joining us for this episode of the Capital Alliance podcast.
Yeah, thanks, Ken. Looking forward to it. I guess, do you want me to give a little background on Topmark and how we got started?
Yeah, that'd be great. Especially since, I mean, you sort of, including myself, I mean, I have a background, I guess, I studied computer science undergrad and then law before I became an investment banker and ultimately a long-term value investor that focuses on compounding. So I think you guys have sort of unconventional backgrounds as well. So maybe that's where work that into how you got into what you're doing now.
Well, let's go all the way back to the beginning then, Jason. Jason and I met in high school and we were both in computer science class together. Right. So unconventional.
Similar to Bill Gates and Paul Allen.
I'd say that's a good comparator.
Yeah, we're on the same trajectory.
Wait, exactly. Which one of us is Bill Gates and which is Paul Allen?
Yeah. TBD. Yeah.
College, I studied, had this computer science background, but I ended up getting into econ, and then some professors figured out that I could write some code. So I got dragged into econometrics. So I was always kind of had a interest in the way the economy works. After college, worked for a tech strategy consulting firm based out of Sweden. Got to live in Sweden for the beginning of my 5 years there, and back and forth between Northern Europe and the US for the remainder. I then took a couple of years off and raced sailboats professionally. And when I did that is really when I got really interested in investing. Doing the consulting work, I wasn't in love with the work so much, but it enabled me to pay off student loans and give me some capital to start investing. So I was consuming books on the investing, everything from technical trading to Warren Buffett stuff. So I didn't have a clear direction. And that all changed when I took this leap to start racing sailboats professionally. I got teamed up with a guy who had got some funding out of New York and to do a double-handed offshore campaign. So he and I joined forces, and the sailing center that we were racing out of, it's called the Oak Cliff Sailing Center, and it's in Oyster Bay, New York. It was a new kind of concept at the time, but The long story short is they were attempting to kind of reinvigorate the offshore sailing and I guess inshore and mat racing prowess of the United States, kind of a center of excellence, if you will. While I was there, I stumbled into a group of people significantly older than me. I was in my 20s at the time, all sitting around talking about stocks. I said, hey, that's kind of interesting. And I introduced myself and asked if I could be a fly on the wall in this meeting. And that led to what was sort of a grounding of fundamental understanding of how I would want to pursue investing going forward. And to tie it back to the podcast, that is actually the source of the podcast. So my mentor, that is a meeting that he was running. He was the person I met through that. So that encouraged me to think about going to business school and switch over to something more in the finance realm. And with that, he said, well, if you're going to do this, if you're going to go to business school, study finance, I think you should just start your track record now, start a fund. So he became my first investor.
In 2012.
In 2012, right before I went to business school.
Pretty good first investor to have.
Yeah. Well, I mean, part of it is I also was relatively ignorant to what the whole running a fund would take. And with his $100,000 and my $10,000 that I had to my name, that's what really started the fund. And as you know well, that's not really enough to launch a fund on. But I wasn't.
Apparently, it is.
Yeah. Well, I think that is sort of the takeaway. Is it if you build your company, build your fund to be not dependent on a certain amount of fees, there's nothing that can prevent you from keeping the fund going. And so Jason and I, we went to high school and college together, went our separate ways in our careers. And meanwhile, I went to business school, started this fund, really starting to understand the way I was investing. We got reunited. But before we kind of get to that, maybe you should give your background.
Sure. So my degree is in aerospace engineering, a little unconventional, and my whole path to becoming an investor is very unconventional. So as one does growing up in Northern Virginia, when you graduate college, you become a defense contractor. And my first job was calibrating government satellites. And in that was the 1 year I used my aerospace background. But in that job, in that role, I taught myself to program because controlling the satellites from the ground is all software based. Taught myself professionally how to write software. And I really wanted to move west. So my goal was to live in Denver, which is also a big defense town. And eventually got recruited into joining the intelligence community and worked for the NSA for about 7 years. During that time, it was a super rewarding experience. It was basically the Obama administration, and we were still fighting wars in the Middle East. So we were building a lot of data analysis systems to process a lot of the communications and data captured in the war zones. But following that, that's when Mike and I's story kind of merged again. So this was 10 years past college. I was leaving government work, which had brought me to San Diego. And we had a mutual friend that was leaving Palantir, and he had an idea for a startup. And he reached out to Mike originally and was asking him if he knows anyone kind of in that space that's entrepreneurial and would be looking for something to do, and put that third person and I in touch. And we eventually decided we need Mike's help to build all the business models and help us pitch VCs in Silicon Valley. So we roped him into flying out from the East Coast. You were living at Newport.
It's the only time I've ever called in sick for work.
Yeah. So we put him on a red eye out to the West Coast. We went to San Francisco, pitched a couple of VCs, ended up getting some funding, and really forced him to quit his job and join the startup community with us.
That was long enough ago when people started companies in the same place, like everybody moved to the same place, right?
Yeah, right.
So nobody wanted to move to Rhode Island. That was pretty clear. But the consensus was we could make San Diego work.
And what was that, a defense tech firm or with the startup?
Yeah, it was. We were very early. We were using machine learning, computer vision specifically to analyze like safe city camera data, helping police look for solve crimes.
Got it.
But it was extremely expensive to run that at the time.
Palantir, this guy left Palantir for this?
Correct.
Okay, so Palantir's been around for quite a while. Oh, yeah. What year would this have been?
2014, I think.
Yeah.
Okay, so you had the fund going already.
Yeah, so the fund was already going at this point. I'd started before business school. So a couple of years of business school, year working, and at this point, like underperforming pretty solidly for those first few years, because like I say, I was still trying to find my footing as to what type of investor I was going to be.
Yeah.
And it all started to click when we started this company. What Jason and I like about venture is the venture capitalists are incredibly good long-term thinkers. And which is sort of counter to what maybe your traditional value investor would say about venture. They think it's just gambling or whatever. It takes a very different portfolio approach. But
it's an interesting perspective. I would say, like, definitely on themes and general kind of trends and things, they must be very strong. But at the same time, my observation, I'm not that involved in venture, honestly, but is sort of like, oh, you just bet the jockey. So it's like, because even the idea is probably going to evolve. It's probably going to pivot. So it's like, don't worry about that too much, as long as it's like just big TAM, good jockey,
and power law outcomes, right?
And power laws, right? Exactly.
So that's great if you're the investor and you have access to the right deals, but it really sucks if you're the jockey.
Right. And if you would say that probably given the power law outcomes, it really comes down to access, right? Because there's probably some general consensus of like what jockeys they want, which is obviously someone who's got some drive and experience, and it's fine if they failed. It's even better if they've succeeded in the past. They're probably looking at that team more than anything. No,
absolutely. But the end result for the team is that if the idea doesn't work out, you're back to zero and you're starting again.
Of course, yeah, sure.
During these first few years of building that company, find out Jason's interested in investing, so of course I show him what I'm doing nights and weekends, and we start working on stuff together. And this vision of how do you marry the things that we like about venture capital with what we like about value investing in a way that enables us to run a concentrated public equities portfolio started to take form.
And so what year did you guys, and before we get there, I just want to get on the record, like, so where did you guys go for college and business school? And
oh yeah. Well, we both graduated from Virginia Tech.
Virginia Tech, okay.
Right. And then I went to business school at the University of Rochester.
Computer science majors?
No, Jason, you were
aerospace engineering.
Yeah, and I was economics.
Got it. So you are an actual rocket scientist, basically, Jason. Right? Is what you're saying.
100%.
Yeah. Okay. I have this. One of my favorite quotes. Not favorite quote, but something I say just almost half off the cuff is, "Nothing is rocket science except rocket science."
Yeah. It's just physics.
So you've got it all covered. Got the non-rocket science and the rocket science covered.
Yeah, exactly.
So that's great. That's very helpful. And so it's been 14 years you guys have been running the fund. What has that experience been like? What have you learned along the way?
Talk about some in the beginning, we were
successes and mistakes or challenges.
So when we started the startup and we realized we wanted to work on investment strategies as well, we would show up to the office early. Most startup people will show up between 9 and 10 a.m. So we would get in a couple hours earlier into the office, work on our investments, building our strategy. And then when the rest of the team showed up, we would start our day job.
Got it.
Which is probably a sign that we're better suited to be investing anyways.
And how long before the startup, whatever happened with that? And then, you guys now are 100% focused on the fund, right? Or funds. Yeah.
Yeah, we did a number of startups. So the first one did not take hold. It's a combination of being too early, and at that point in time, so 2014, 2015, 2016, it was very difficult to sell into it's very difficult to sell into government today. It was very unpopular back then to even consider doing a startup that sold into the government.
Right.
Palantir was basically the only one that had proved it out. And at that point, it wasn't yet proven out.
But one lesson we learned was the winners will stay alive long enough for good things to happen.
Yeah.
And we didn't stay alive long enough. Yeah. But the good thing happened less than a year after we shut the business down. Was our potentially largest customer had a several $1 million deal for us that he called us up I don't know, 9, 10 months after the business closed doors and said, I've got your contract waiting now.
Yeah.
Let's start.
It's really, it's a duration mismatch, right? So startups raise capital to have 18 months to 2 years of runway. And then, but the timeline to develop a government contract is probably 4 years. So this particular contract we had been working on for a while, and sure enough, it did.
Did he not realize that you guys had like closed down like 9 months earlier?
Yeah, well, we had another, we had a lifeline from a city to bridge us there, and unfortunately, for a combination of reasons, they dropped it because they got sued by the ACLU for certain surveillance practices unrelated to us, but anything that had anything to do with surveillance got dropped. So it was sort of like that put us in a position where it was just no longer able to make it go forward. And that's the thing, as Jason said, any startup is generally seated in a future reality that has to occur. But in order for the startup to capitalize on it, it has to stay alive long enough to get there. And when we go through these funding cycles, like, during COVID, you could get money from anybody for any idea in venture. And then everything turned in 2023 and a lot of companies had to fold. It's not many entrepreneurs have lived through multiple cycles and be able to actually see that and recognize it.
And so what you guys, that one got?
Yeah, we closed the doors on that. The next one we did was.
So what year was that?
16?
Probably 16.
Within a year or two. Yeah. Okay.
The second company we built was in the clinical trial space. So similar technology, machine learning applied to clinical trial data with the idea of helping build better clinical trial protocols. It was early. Obviously, doing that today is relatively trivial. We were using natural language processing to basically tokenize clinical trial protocols and provide recommendations for pharmaceutical companies that were running trials. That company did end up selling, but not at like a great exit. It was came to a situation where we were, again, you had to keep, I guess this was a good learning that we had from the first one, is like, we knew we had to keep the company alive in order to be around. And we got to the point where we had too many people and not enough incoming revenue. So really, Jason fired himself, I fired myself, and we left my co-founder on, and she was able to keep it going to the point where they were able to sell it a few years later.
Okay. Any other startups together?
So when I left that, and San Diego is really a town of defense work and biotech. So it's kind of natural we migrated into the biotech industry. And so the next startup was really around facilitating the conduct of a clinical trial and capturing patient data. So this was mobile apps to allow patients to record outcomes during the clinical trial without having to go to a clinic, without having to fill out paper. Because at the time, most of the industry was still run on paper. And this was, now we're in 2019, going into 2020, COVID pandemic starts. We quickly got inundated with an incredible amount of business. Patients could not go to clinics anymore for anything that was non-emergency, conduct their clinical trials. Everything had to shift digital. So we had more work than we could fulfill.
Oh wow!
And that was really a wild time. It was a roller coaster. Everyone, was sitting at home, sitting on their hands, not doing a whole lot. Where I'm working 20-hour days and not sleeping and eating burritos all day. So detriment to my health. But we were involved with several really interesting trials, COVID related. The most interesting was Regeneron's monoclonal antibody study. So this was the IV bag of antibodies that you could get if you had a hospitalization for COVID, and it really jump-started your immune system. So that was a wonderful drug. I don't think anyone in that study that was hospitalized for COVID ended up passing away.
What ended up happening to that drug?
It wasn't distributed wide enough. It was approved. I think it was the first treatment that actually did receive approval. It just wasn't, they didn't have the reimbursement mechanism. Back to the way clinical trials are designed, They pick a very narrow set of patient population that they know that they have a good idea, at least that they can get this approved. So
I see.
then the FDA approves it, and then you can basically only market it to that patient population. So they didn't take the emergency measure and say like, hey, this works. Let's give it to anyone. That didn't
I
occur.
see.
I think that would have
That's
been a
odd.
huge benefit for the nation if that did occur.
Yeah, interesting. And what happened to that company?
It was Regeneron. They're
No, I mean your clinical
the startup. Yeah,
labs.
we ended up selling that to LabCorp.
Got it.
Yeah.
Okay. So that was a successful exit relatively.
Right.
Yeah, that's great. Yeah, so let's pivot back. So obviously, Buffett has this saying about being a businessman and an investor and how they're symbiotic with each other. I guess you guys want to reflect on that?
Yes. Starting as an operator versus an investor, I think investors tend to have less patience. I think that's even true maybe in value investing circles, in that it takes a long time for a strategy to come together. A startup in particular will take a very long time. But if you're turning around or changing the strategy of a large company, I mean, they move slower. The results are not going to be clear early. So I do think there is something to that, is having an operating background is probably, if not a prerequisite, a really beneficial thing to have as an investor.
Yeah, for sure.
And I think the two of us having different backgrounds and very different ways we look at a problem solving and analyzing a business is really a benefit as well. It's not only having a partner, so you have someone to bounce ideas off of all the time, but coming at it from two different angles.
Yeah. And frankly, our returns when we started working on stuff together went way better.
Yeah. So talk about the current funds now, how they're positioned, where you're seeing opportunity, what you've learned about running funds.
Sure.
Together,
so maybe we'll start with Top Mark Capital Partners, since that's the main fund. It's a generalist fund. It is a concentrated public equities fund. For a long time, I didn't want to call it a value fund, and I'll explain why. But what Jason and I kind of figured out is these high level thematics provided a sort of top down approach to deciding what companies we were going to research, and we followed kind of cash flow based fundamental analysis to select the companies that we liked. So I didn't really consider it a value approach until I met more people that did different types of value. Value really, I think at the end of the day, and I wrote a paper on this at the end of our Q4 letter, it's over time, principles get integrated into markets and they get arbitraged away essentially. So if you go back to Graham and Dodd and securities analysis and the intelligent, most of those things that he teaches in those books, well, true, are pretty much non-existent today. Like you don't get net nets unless you go to a foreign country with less good implementation of property rights and whatnot. So what happened over time? Well, Buffett, obviously his disciple, evolved to recognizing the value of float and insurance, and then utilizing that, recognizing the value of intangible assets on the balance sheet. Take his Coca-Cola investment, for example. I think that as a value investor, you need to recognize that what's happened in the past maybe isn't going to give you superior performance over the long run. The challenge is determining what is the next thing. Again, these things evolve over very slow arcs, almost like one theme dies with the person that comes up with it. And so for us, I think having the technology backgrounds has been helpful because it's enabled us to look at companies that some people might have looked at and said, oh, the P is too high, or it's a technology company, I don't trust it because I lived through .com. And at the same time, I think we can have a rational outlook towards like the nature of software today versus valuations have always also have come down, but you have to recognize the fact that the very disruptive force has entered that market with the large language models and artificial intelligence. So yeah, what would you add to that, Jason?
I like to fill the Charlie role, so nothing more to add.
Well, I would say, like, going back to that point, that's sort of where value does meets this new idea of like, well, you have to figure out what's next, but at the same time, if you're wrong, you tend to get taken out to the woodshed, right? Whereas if you find something that isn't popular as reflected in multiples, there's probably less downside if you're wrong, and potentially maybe things will either turn around or mean revert, or just it's too cheap.
Yeah.
So we're at an interesting time right now because we're recording this. It's June of 2026. Obviously, this year at least, and probably for the last year and a half, but it's just become more and more pronounced, is the AI trade. And SpaceX is basically the other, recently, SpaceX I think is public for 2 weeks now. But the AI trade is pretty much where all the money seems to be flowing. So you have companies that 10x'd or more in just within a year, thinking like the memory companies. It's basically everything related to like a story about a bottleneck in AI data centers seems to be flying high. Some of these sort of vertical patterns, when you see a company that's been the same for 10 years or 15 years in a range, and then all of a sudden 10x's, and historically cyclical business like memory, definitely, the question is like how, it's a very much a momentum market. So any thoughts on what we're seeing in the world of like large tech companies and momentum and AI?
On the memory part, I'll play the pessimist real quick. It's become such a bottleneck that I think the software engineers can solve around it. They're trying to maximize the context window of these AI language models and hold as much data into memory as they possibly can. But the end goal is that the context window is all the data that you have. So you can't load that into memory ever. So I think I have to imagine that the frontier AI labs are working incredibly hard on how to get around this need for huge amounts of now very expensive memory. So I think it's still a cyclical business just due to that.
Yeah, this time it's different is really right. But how long this memory cycle lasts, I mean, there are some physical constraints, right? Like it will take a certain amount of time to build a new fab. But what do we know about the capital cycle? The memory companies will print more free cash flow in the next year than anyone. SK in particular will print more free cash flow than any individual company. That will attract a lot of capital to go after it. And I think the thing to understand that's kind of different than like a cement factory, right, is that there's other ways to solve the problem than just adding more memory.
Yeah. And they're adding capacity. At the end of the day, this is still just an undersupplied commodity. Whereas I think the AI, like the chips, the processors are highly specialized, and that's more on the bleeding edge. And
the real value investment here would have been to invest at the bottom of the memory cycle when they had negative margins.
Which some good value investors did, but they sold it after, they've jumped up 50% or 100% or whatever, as value investors typically do, and it would have been right the other 9 times, but this time they left 10x on the table or more.
Yep.
Oh.
Now your question was more about like what else around big tech. You have a couple of things that are moving simultaneously. You have OpenAI and Anthropic, who are kind of the two most important. Plus, I guess you could add XAI as a third,
and Gemini. Yeah.
And Gemini. So between those 4, 2 of them, the largest of the 2, or the most vocal of the 2, Sam Altman and Dario, have, I think, done a really poor job with public relations. And that you watch one of the AI, the Stanford commencement address that Sundar gave, and people walked out. We have this fantastic of a technology that is enabling people to have more agency than they've ever had before. And yet it's very unpopular. It tells you that the people that are leading these companies that are doing this are doing a really poor job of communicating to people how this can help them in the future.
No, I'm not sure that I would necessarily go. First of all, like what tech founders have done a great job with being public relations.
Not many.
Good at it. I can't think of any really. Steve Ballmer, I would.
No. Well, maybe Steve Jobs. I don't know.
I mean, yeah. If you could think of anyone that maybe could be a candidate, it could be Steve Jobs. But even Steve Jobs, it was more like his product was so great, and he was an evangelist for his product and a great salesman. But as far as like actually PR or like trying to manage perceptions of people, I don't even know.
I think
put Steve
Dario's
Jobs
just
high
been
on that
outright
list.
hostile, though, to say that this is going
Has
to
he?
kill jobs and there's not going to be.
Oh, and that's
we're going to have to go to universal basic income. Oh, and this is such a threat that the way they handled Fable and Mythos really has boxed. I think this has boxed them into a corner, and it's put them in a position where the trusted source, which is Amazon's AWS, Microsoft, Google Cloud, are in a much stronger position. So, I think that Anthropic's going to do great. I think OpenAI is going to do great. But who holds the compute? Right now, it's those three companies.
Well, I wonder though, right? Because you have the energy power layer, you have the physical like data center layer, and you have the model layer, and then you have the applications that can be built on top. And then in the model layer, you have these sort of, I guess, 4 closed models, mainly 4. And you have a bunch of open source models that are, right on their heels, I think is fair, but much less expensive. And you get much more control. You can host them and all these things. So is it clear to you that the economics of being in that LLM layer are actually going to work out great for Anthropic and ChatGPT?
Software is, and it is software at the end of the day, right? You can fit the weights on a USB key on this thing. So that said, all of us are using these models, right? We use it heavily in our research, and Anthropic models are better than DeepSeek models. They are more expensive,
ChatGPT, you mean?
But again, the value that I derive is generally so high that I don't want to worry about the difference in the cost. And one thing we know from the last couple of years of the stuff being in market is that token costs go down, and they go down at a relatively predictable rate over time. So having the best model is great. I think the pressure that you're seeing right now, certain companies in the last couple of weeks have talked about how they're going off of Anthropic and moving workloads over to open source models. That all makes lots of sense. And at some point, Anthropic will probably offer a lower, much less expensive model in order to retain that business within their ecosystem. In the same way today, they offer Haiku and Sonnet as those means, but they'll likely have to get more price competitive on that.
It's actually a really interesting case study. And I mean, I think AI is probably different, but if ChatGPT is like the Hertz and Anthropic is the Avis, seems like Avis really kind of got to jump on Hertz, like quite a bit. What do you attribute that to? And then going back to the model, I'd love for you guys to comment on where do you think there's still opportunity in the layers?
As far as Anthropic versus OpenAI, I think the pretty clear mistake OpenAI has made is focusing way too much on the consumer product. If you remember from their history, they launched ChatGPT as a demo of like, what are the capabilities of this technology? And so many people signed up for it that they were forced to start thinking, oh, this should be a consumer product. And what Dario and the Anthropic team realized earlier than the OpenAI team is that one, software is a language, right? It has rules and structure. In fact, it's an easier language than English. And 2, the most likely adoption and who's going to be willing to pay the money for this is going to be businesses, because you're replacing something that might take more time with a person, or you're making a person many times more productive. Who would want to pay for that more? The individual who's planning a vacation to Hawaii and wants to schedule flights and stuff, or the company that's paying multiple hundreds of thousands of dollars a year for information workers per person that can get 3 to 5x the scale on those people? So I think Anthropic just recognized that first. OpenAI was earlier and more distracted and spread their cards out too thin.
But it's a gap that probably can be closed.
Absolutely. I mean,
I would think
OpenAI's latest model, and if you use Codex, it's just as good at this point.
Yeah. My son actually works at OpenAI.
Oh, very cool.
You guys know that. And there was a period where he was like, yeah, cloud's better. And then he's like, this was about a month and a half, 2 months ago, maybe like April. He was like, Codex is actually kind of better now.
Yeah.
At least for programmers and stuff,
The trouble is that people, ourselves included, right? We've now moved everything over to Claude.
Yeah.
And you get comfortable with it. And now you have switching costs, right?
Yes.
So,
Correct.
Back to like, what is a value investor? One of the frameworks that we really like for looking at a particular business is Hamilton Helmer's 7 Powers. And if you haven't read the book, phenomenal book, very easy to read. We always give it to our
Isn't it similar to, I mean, there's some overlap with Porter's 5 Forces, no?
It's really an evolution of Porter's 5 Forces.
Yeah. Evolution. Okay.
One way to think of it is Michael Porter will give you the layout of the neighborhood, and Hamilton Helmer will inspect the house.
Got it. Okay.
Right? So you're like, I want to be
another level down
on this part of the neighborhood because this part of the neighborhood's good. How do I assess if this company has a stronger moat than?
Well, take a look. Like, let's bring in software as an example, SaaS. You would look at it with the Hamilton framework and say, hey, this is like excellent business, high switching costs, recurring revenue, blah, blah, blah. And then they all get taken to the woodshed, obviously, because this now alien technology drops into Earth. So I know you guys have looked at it. I've looked at it. A lot of other people are looking at it. What's your take on all these companies, these great companies, Adobe, Salesforce, very profitable still. You alluded to it earlier, but let's double click on it.
There's a lot of threads to pull here. Since we mentioned switching costs, let's start there. The main thing that's happening with switching costs is that switching costs are going down very quickly, very, very, very fast. One of the things I did in my first job out of college in tech strategy, we would advise on the post-merger integration of telecom companies. And that would be like a billing system, an order management system, all the stuff that you need to run a telecom company. And it was ungodly expensive. It was really hard to do well. Our company, the reason that I got hired and the reason that it became a very good company and got acquired relatively quickly is that we took over a project that Accenture was failing to deliver. They brought our company in, we delivered it on time. And it's just one of those things it's not easy to do well, and adding more people to the problem doesn't necessarily solve it. What does AI do in this? Well, if you listen to the most recent Snowflake earnings call, for example, a lot of their customers are switching from legacy databases to Snowflake, namely like Teradata. Their ability to transition a company from Teradata into Snowflake is much, much faster than it used to be. And that's because they've built their own harness. It's custom to the way that their software works, and they can do a much more efficient transition. So switching costs
because of AI.
Down. Yeah,
because of AI. Yeah.
Now the same thing is true on the other side. That means you have more potential competitors at the same time. So barriers to entry are going way down.
So which software businesses do you look at and be like, hey, this is unfairly punished right now? Any come to mind?
Yeah, there's a few. Without getting into specifics yet, I'd say running a software business is only a third of the company's engineering. And of that third, you have product designers, you have people doing research on customer research. So maybe half of that team is actually software engineers writing code. And then senior engineers write code 50% of their hours, their work hours. So the amount of man hours spent writing code at a software company is actually very small. It's really just a sales organization wrapped around a product. So that's one lens we've been looking at lately is just because you can replace the 10, 15% of the business that is actually writing code doesn't mean you're going to replace all these software companies. There's so much more to it and we learned this from being operators in software businesses is you can have the product and it can be a great product, but the company can still fail. It's, it's a lot more than just having software and being able to iterate through new versions at a rapid pace.
And anecdotally, like we talked to a lot of startups. Most startups are still paying for some sort of SaaS, right? They're still using HubSpot, or they're still, there's some of these kind of core things that they're still paying for. So we're not yet seeing that now.
Salesforce too.
Yeah, we talk to startups and we talk to very large software companies, and none of them have said they're ripping out SaaS products out of their stack and rebuilding them themselves. None of them are doing it.
Yeah.
So why is the market not giving them more credit?
One way that we look at it is, do people love or hate this product? And people really hate paying for Salesforce. It's very expensive for what it delivers. And you could get an equivalent or near equivalent product for 1/10 of the price, not mentioning, not those before AI, right? So again, switching costs are going down, and yet I wouldn't bet that a lot of companies are going to rip out Salesforce. Salesforce is going to figure out how to make sure they deliver more value to their customers so their customers don't leave. And you're seeing, if you look at the job postings for some of these companies, forward deployed engineers, which was a term coined by Palantir, actually, where they would basically embed a software talent. It's basically a engineering sales role. Embed it with the customer, figure out what the workflows are, and make the product work for them. So we have a theory that the horizontal SaaS companies are going to become more vertical, right? Because they're going to go into their largest customer and make the product work really, really well for them. And then they'll figure out how to wash, rinse, and repeat that business. But that brings up another view on this, is that how much different is a software company than a consulting firm?
No, I was going to ask, so like you, on the one hand, you have Constellation, which is a collection of verticals. And you have things like Accenture, FTI, that are consulting firms, right?
Yep.
And then you have things like S&P Global and Visa and MasterCard and things which have these like networks, and they're all, I think, affected by fears around AI.
Yeah. So a specific company that I like, and we don't have a position in it, is Toast. And it got sold through the SaaS apocalypse as well. But they're really a hardware tool in restaurants. So I think that was one that I view as unfairly punished.
This podcast is sponsored by the Capital Alliance Mastermind, a private community of asset managers and investors building something real together. Members gather in person a few times a year to tackle the hardest problems in investment management: raising capital, scaling operations, and building relationships that move the needle. What makes it different is the room itself. These are people who share deal flow, make introductions, and hold each other accountable, because everyone is committed to giving, not just taking. We're currently building our next cohort. If you manage a fund, join the waitlist in the first link in description.
If we fast forward, where is this going to go in a year or 2 or 3? What can we say about what the world is going to look like?
2 things. One, the human mind does not do well with exponentials. But if you were to look at what AI was capable of 12 months ago to now, if you just extrapolated that one more year,
completely agree. Yeah.
Forget the exponential curve. The quality of the output is only going to get better. And what does that really mean? That means intelligence sort of gets commoditized. These things will still, go back to Hamilton Helmer's 7 powers. These are actually more important now as a result. Your cornered resource, your switching costs, the things that make your customers want to come to you. And at the end of the day, it's value delivered versus value captured.
Well, I, for one, am very excited that I'm alive during this AI era, because I used to dream about it. And it is like an alien technology dropped in just suddenly in like 2023, and now is just exponentially better. I remember trying to pull up even images in ChatGPT. They were pretty terrible like a year ago.
Oh yeah.
And now they're incredible, only getting better. So yeah, it's really incredible. I'm a big fan of Substack. I know you guys have a Substack, and I have one as well called Compound Ideas. And I've been writing recently about Musk and stuff, but also what is it potentially? What are the implications potentially of a post-abundance world, right? Because a lot of our assumptions are built around this idea of scarcity, and then capitalism exists to create incentives so scarce resources can be allocated better. But if everything drops to the cost of energy, because energy powers cognitive work and it powers physical work eventually with robotics, then you don't necessarily need an economy that allocates scarce resources. Now, this is not an imminent thing. I think it's probably 30 years out or something. But then again, like you said, human brains can't handle exponential. So I don't know if it might be sooner,
We looked at prior industrial revolutions. And actually, Jason, maybe you should talk through this, because Jason wrote 2 very good papers and we're probably due for a third one at this point, on the similarities, or at least what happened back then. And I think that can provide an outlook for why and what's happening in the future.
Yeah.
Sure.
Yeah. So
that'd be
I
great.
started by comparing the first and second industrial revolutions to where we are today. And the first industrial revolution was at the turn of the the invention of the steam engine, the locomotive, and that really foundational base of mechanical work. And a lot of what was done for that next 100 years was a person operated a mechanical machine, and it really boosted their productivity. But it was like building a base of knowledge on how to build machinery. And then at the late 1800s was really the second industrial revolution, and we automated a lot of those mechanics, the machine. We invented assembly lines and highly the production of the Model T and all that. So where we are today is in the 1990s, we had this industrial revolution, personal computing,
information revolution.
revolution. We digitized basically all of human knowledge over that 10-year period. And we invented the mobile computing. But it's humans operating computers. And here we are today at maybe the second information revolution, and we're automating a lot of that. Now that we've digitized everything, we've learned from it, we've built the building blocks to have this second industrial revolution that we're starting now, is our feeling. And when the prior industrial revolutions happened, we had a really step change in GDP. And after the second industrial revolution, we're growing GDP at 3% annually, and it plateaued. So we had a step change, and then there was a new course of growth for humanity. And we feel like a similar thing's likely to happen in the next 5-10 years here. Is we'll have another step change. I don't know where GDP growth goes, but maybe we grow 5% every year for this foreseeable future.
So I totally agree with you. I think productivity will go up and economic output will go up. But I guess the question in my mind is more around if human beings are not needed for that productivity or economic output. If companies, for example, don't need to be run by management and organized to take inputs of resources and whatever, because basically DAOs, digital autonomous organizations that can be organized with AI and robots can do a lot of everything you need, then, do we have a system of capitalism the way it is today? I don't know.
I don't think any of these ideas are necessarily new. And the concept of the loom was very scary to people that were textile workers back in the day. Right. That is, if I remember right, that's where the concept of the lemmings or the Luddites came from. So much as it's easy to stoke fears about these things, there's nothing about the past that tells us that this will be anything but net positive for people and standards of living.
Yeah, certainly overall, the course of technology has been positive for material wealth. Higher productivity can be distributed in whatever fashion.
But even if it's unfairly distributed, the standard of living at the lowest end of society should
still go up
massively.
Right.
Oh, yeah. I mean, the bottom 1% in the United States versus the top 1% 150 years ago. I mean, which would you choose?
No, I've absolutely, I'm on board with that, and I've written it. Although, as a counterpoint, I think people tend to measure status and happiness relatively, not in absolute terms, compared to somebody that was alive 100 years ago. But that is absolutely, I think, a correct point economically.
Yeah.
But the difference now is with technology. Like, for example, when social media came out, I would not have intuitively guessed that it would create a lot of mental health issues for a whole generation of young people. That was not intuitive to me. However, that having been said, we kept it away from our children, and my kids were born like in the early 2000s. So I think we were relatively early. So we didn't really see that it would serve them, but a lot. So that's not intuitive. So it can be true. Like, for example, it's increased communication and has a lot of benefits. So it can be simultaneously true that the world is much richer, and also that there's greater inequality or some other mental health or other problems that are caused by not having meaning or not having purpose.
There's
from
precedents
work.
for that. So during the prior
Yeah.
industrial revolutions, if you gauged, and we read books on the topic and stories from that era, and you gauge the population's sentiment, and it was very negative. And they thought the economy was crumbling. And it's kind of parallels a lot what you hear today, that the economy is not good. But then you look at the numbers behind it, and it was accelerating.
Yeah.
So I think we're likely to see the same kind of situation. And it took a while to flesh out, but
yeah, reminds me of that quip that a recession is when your neighbor loses your job, and a depression is when you lose your job.
Yeah.
Another
way to look at this is technology evolves at a much quicker pace than biology. And we know this as investors because the markets are often very irrational. And it's our lizard brain, as we refer to it, as it's your lizard brain that holds you back from making good, rational decisions. But even the best of the best make those mistakes.
Yeah, absolutely.
When you throw technology, whether it's social media or whatever, at a child who's a developing reptilian brain, don't be surprised if they end up having consequences, positive or negative, that were not anticipated.
Yeah, that absolutely makes sense. I think that's a good segue to, I want to talk about healthcare and biotech. I think one of the I'm not a healthcare biotech investor, and I think in that respect, you guys are relatively in the minority as far as I know people, is that I don't think a ton of value investors tend to feel comfortable with healthcare and biotech. But I think especially given that AlphaFold just sequenced all the proteins, and how basically I think we're on the precipice of just incredible advances and the pace of advance due to AI and cognitive processing. What do you guys think of where the opportunities are? Now, is it still the case that biotech is sort of unpopular? Because I guess I just read an article that the index has come back a long way.
it has come back a long way, but it spent years being very unpopular.
Okay.
At least I think the last 3 years funding's really dried up. So there was a huge bout of it through the pandemic years, and then that all kind of dried up. And M&A is really the engine of the biotech industry. So if you start a biotech, you're hoping to advance your drug to phase 2, phase 3 clinical study and sell to a big pharma company. So if that sale's not there, the scientists frankly don't get rich and decide they're going to start another company. The VCs don't see the return that they can then roll into the new crop of companies. So the funding all froze for several years, and we're just now seeing that thaw.
Because those big companies stopped buying the minnows?
Yeah, acquisitions slowed down, funding slowed. A lot of money got
Why did that
sucked
happen?
out of. I think there's a couple of reasons, but one of them is AI. A lot of the venture money shifted to AI. It wasn't popular to place money with life science, healthcare, biotech VCs.
Well, should we talk about China and licensing? Because another thing that's happening, and this is actually more recent, is 2 years ago, almost nothing was in license from China. But today it's in the 40-something% range.
Meaning that 40% of all the things that like US or global companies are in licensing are coming from China.
Yeah.
Chinese research.
And what they've done is they really commoditized the chemistry. And what does that mean? Is they've taken patented molecules and modified them slightly and created a market for it. And that's been very good for the large pharma companies like Lilly. Not necessarily good.
Who do you guys think are the beneficiaries, and who gets hurt by the coming, or maybe it's here, revolution in AI and biotech and healthcare?
Loses. I think there's a lot of winners.
Yeah.
I think I really like the space in general right now for several reasons. One, you brought up AlphaFold. We're going to be able to design new therapies a lot faster. These Chinese biotechs, like, we need to figure out the protecting our IP challenge. But the way they got started is providing low cost early stage research to US biotechs. And that's a real benefit if you want to cheaply start, pursuing an idea. So yeah, there's a challenge there with China, but we'll figure it out. And maybe we can do things.
It's not all bad. I mean, like having a low cost, high volume chemistry basis of expertise is great for everybody.
Mhm.
Yeah. But
When you say chemistry, I don't know. I think of like nitrogen and oxygen and things. But you're talking about a pharmaceutical chemistry. You mean biologics?
Both.
yeah.
Yeah.
Okay.
So,
I mean, a lot of it is combining chemicals to make a chemical compound that you're trying to make. You need to figure out how to make it at scale.
Mhm.
yeah.
So are you saying that China will just like kind of be to chemicals the way TSMC is to chips? You just outsource it to them and they make it for you?
I mean, that's obviously happening in some sense now.
Yeah.
I mean, it's,
Okay.
I don't think it's going to be everything. But
Okay.
remember, this revolution happened in the 80s, right? Like Vertex Pharmaceuticals and Regeneron were probably the first of the early, we're going to design the molecule.
Mhm.
And that was very hard to do back then. I mean,
Mhm.
they had complicated computers that would like try to help them do this stuff, but it was definitely more a dark art. And it's evolved today where, not only can everybody do it, but China's figured out that they can do it at scale and scale the operation.
Mhm. I see. And so where do you guys see the opportunity in the next, say, 3, 5, 10 years on the healthcare biotech side? I'm talking big pharma companies, biotech innovators, there's venture, like in the whole ecosystem.
Yeah, well, I'll tell you one way the whole
Diagnostics,
stack's
et cetera.
going to benefit is a lot of the recent changes the FDA is making along with federal regulation. And they're trying to cut out a lot of the downtime and wasted time in bringing a drug to market. So right now it's a 10-year process. And once it's in clinical stage, so you have to file to have your new drug investigational new drug, then you run your studies. When you conclude your study, do a data analysis, which can now be aided by AI. Then that package gets sent to the FDA. They sit on it for a year, make a decision at the end of the year, and then tell you if you can go forward or not. So there's this back and forth that happens several cycles. And they're trying to cut down on how long, the data analysis process to submit it to them, how long the FDA takes to look at it. Can they use tools to speed that process up? Can they streamline the number of clinical studies you have to run? So we're compressing this whole timeline, and we're compressing the preclinical before it gets to humans, new regulations around how they're going to govern animal studies. So once you develop your drug, you have to patent it, and that starts a clock. And then that clock determines how valuable the drug is after it reaches the market. So the average drug, once it's commercialized, is on patent for 7 years.
Mhm.
And if we can compress the dozen years that it takes up front, and if your 7 years that it's on patent can go to 10, even just adding 3 extra years probably doubles the value of the drug, because the first part of commercializing it is you're going to get insurance coverage for it. You're building your sales force. You're educating physicians. So by the time you're at year 7, that's your peak sales. So if you can extend your peak sales a couple more years, you've doubled the value of the drug. So I think we're going to see, we're at the early stages of this, but we're going to see the value of all these drugs dramatically increase.
Very
Now,
interesting.
there's another dynamic to this, though, is the U.S. healthcare system is on a one-way track towards insolvency. And so just like in technology, you need to be very careful about what you choose to buy. The same thing goes in the life sciences, because if your value created for your product is less than or not significantly more than what you charge, then don't be surprised if say we go to a Medicare for all. Don't be surprised if the U.S. starts negotiating very heavily, as this administration has already started to do, in order to reduce those costs. So currently, the market today could be very different. But if you focus on companies that deliver a significant amount of value, given the cost, I think you can choose some very good companies.
Yeah. Now a headwind until all this happens is these big pharma companies have a lot of patent cliffs coming up between now and 2030. So this is why the M&A is starting to kick back on right now, is they have to buy drugs to fill their pipeline, their sales pipeline.
I think this year there's already been more acquisitions this year than all of last year.
Right. Right. I think we're on track
So-
for one of the largest years of M&A.
That was your prediction, right? This is going to be the largest M&A year on record.
So we have another 5 or 10 minutes left, and I want to touch on at least two other things. So one of them is how will we as long-term investors be able to harness AI to make better investing decisions? I think you guys are doing some innovative things. I know Brian Lawrence is as well. So maybe touch on that, and then I want to talk about Capital Alliance a little bit too.
So I think investing, similar to software, creates a lot of leverage over one particular individual, right? You can get a lot out of a little because money scales, and so does software. So with that, for us, we see our ability to continue growing this fund for a very long time without necessarily adding heads, which will be good for us. And in the long term, it'll be good for our investors because we'll be able to take down our management fee, and that all will enable us to run a much more efficient operation. But efficiency aside, how do we make better investment decisions? Break up the tasks that one has to do as an investor. Many of them now, you can just automate some portion of it. Now, if you're brand new and don't know what to look for when you find mistakes or in order to get the type of result that you're looking for, I think that requires a level of experience. But I think we're in a pretty unique position because of our technical backgrounds in order to build the systems to support those processes.
It feels very value add, but you brought up Brian Lawrence, and we talk about the new things we're doing with AI, and so does he. But that at the end of those calls, he likes to say, "But has it made you any money?" And we can't, put our finger on it yet.
Yeah, I mean it's
it's interesting because I saw this chart of like how already the companies that are using AI are outperforming the ones that aren't. And obviously in like small business sector, there's probably going to be a lot more that aren't than are, just by the nature of small businesses. So I think it's interesting, like if, at least based on your experience, and you guys are probably more advanced than others, what are some ways that a fund manager can really start to leverage AI, in a practical sense? Like, should you get Claude Code and have it do X, Y, Z, or should you be coding custom applications, or should you be using a service that's out there that, you just maybe don't know about?
Eventually there will be services, there'll be the Bloomberg of AI or something like that. But for now, I think of it a couple different stacks, right? If level one is just chatting with ChatGPT, right? Or Claude, or choose your favorite chatbot, you can get a lot out of flushing your ideas out with a chatbot. Chatbots tend to be incredibly sycophantic. So you need to take steps, update your system prompt instruct it to be critical, instruct it not to compliment you, instruct it to challenge you. That would be level one. I think level two is when how do you pull all of the information that you need into one spot? And I think now pretty much all the chat applications have like projects you can dump files into, whether you're using Notebook LLM or you're using ChatGPT projects. These all enable you to basically say, I want to take all this stuff and I want to work on it with the help of an LLM. I think that can be really helpful. Once you move into Claude Code or ChatGPT Codex or one of the others, you can move into defining skills. So like these are things that you will do over and over again. For example, many of us use a lot of checklists, right? When you're looking at a company so that you don't miss something, you build a checklist over time, and maybe you add to that checklist over time. Those are perfect templates to move into skills and have the AI do the first pass analysis, if you will, on it. Going beyond that, you will, in kind of where we are, is we have a central repository of data that Jason and I and our AI agents share and feed into. So it's a combination of new data comes into it every day. And we contribute to that every day. And then we've built workflows that run autonomously in loops around that data. That kind of spans the gamut from idea generation, knowing what the AI now knows about us, what is a really good company that we should look at. So we're using it from the perspective of can it make us more efficient, make us make better decisions, because we're going to look at more companies and we're going to look at better companies than we otherwise would have. Another thing we have is we have an internal podcast that's just for Jason and I. And every single day that shows up on our podcast player. And what does it do? It basically looks at our database and says, this is all the new stuff, and this is how it relates to your existing positions. This is how it relates to your watch list. So instead of spending hours doing essentially that task every morning, we're getting at least some chunk of it done in a podcast on the drive to work.
Just so people can visualize the effort it took. Is this you have your own server, you use Cloud Code to create these workflows and applications? Is that generally how it works? Yeah,
Cloud Code has been the workhorse. We've experimented with OpenClaw. In fact, our earliest trials with OpenClaw. I think for our purposes, we're a little more technical, so we could handle Cloud Code a little better. And I should say, like, Jason and I have a good delineation in this, because you've heard the concept of vibe coding. Vibe coding is great for somebody with lots of ideas and no technical knowledge. Since my coding background is so old, I can vibe something up and then show it to Jason, and Jason can say all the reasons why it's bad, or at least make it more robust.
And
that
then
makes sense.
From my perspective, I delay doing things because I know someone else is doing it and they're going to open source it or release it, in the next month.
In terms of creating new applications or whatever, just like wait for someone to release it.
Yeah.
Just as a practical matter, I think you mentioned it to me, Mike. I just wanted to get another reminder of it, that like if you want your AI to be able to access, market data or fundamental data or whatever, I think you mentioned the way you guys do it that you thought was pretty good.
Yeah, there's a bunch of different APIs out there. I won't name particular ones, because just Google financial data API, but you could also just create a skill. And we have this that will go to the SEC website and get the document and manually scrape it.
Oh, okay.
Which is, I think it's, regardless, it's still important, because if you were, say your old workflow was on Bloomberg, right? At least for the type of investing we do, where we aim to do a whole bunch of work up front and own the company for a very long time. You may do all that research on Bloomberg with consolidated financials and a pre-populated model, but before you pull the trigger, you're going to go back to the source documents. So yes, plugging into an API makes that first part easier, but it should never eliminate the side of this is really coming to understand the company and being able to be critical of your own work or your AI's work.
Well, we purposefully pulled out some automation too in the past, where we force ourselves to read the 10Ks and the 10Qs, and we don't want to outsource that.
Last few minutes, just wanted to, so Capital Alliance obviously is a community of fund managers who get together multiple times a year. You guys are part of that right now. And the reason we created the community is like we think that relationships compound, and in person multiple times a year is how relationships can compound the best. Plus, in a world where we're all connected by digital technologies, true in-person community is sort of harder to find. And just wanted to get your thoughts on sort of the Capital Alliance community.
Yeah. So think about like the type of people that start investment funds. It's generally, at least for us, is you have this level of curiosity and some sort of drive to find the truth. That skill set tends to favor more introverted people. Tends to, not always. It tends to favor more analytical people. It tends to have fewer super outgoing salespeople. And yet, for most funds, running a fund involves a good chunk of the latter. So I think for us, we have a lot of benefit that we get to work together every single day. But there's a lot of single fund managers that are solo by themselves all day long. Either way, we've gotten a lot of benefit out of talking to other people that are doing similar things to us and sharing what we've learned. I think, Ken, you're 100% right that somehow people are becoming less connected. So providing a venue to enable us to get together has been really powerful. And I think it's something that a lot of people should consider.
Yeah. The members are from all over the US and a few in Europe. And yeah, we live in San Diego, and there's very few people here that we know do anything similar to us. So to have a community where you get together a few times a year and everyone's doing roughly the same type of investing is, it's hard to build that otherwise in your local community if you're outside of the New York area.
Yeah. I'd also say it's just fun. Like in the early part of my career, you'd have to go to these conferences, and I hated going to these conferences. But like, this is really fun in the same way that kind of the value X stuff is just really, really fun because everybody has this shared common ground. It's really
then they're friends of yours, right? So you're looking forward to showing up to a conference because it's your buddies.
Exactly. Yeah. That's sort of the idea, is that obviously there's like the formal programming and there's the ideas we share and the help we ask for and all those things. But I'd say like half of the value is the dinners and the lunches and the informal conversations and the unexpected serendipitous things that sort of start happening. And then, certainly because I have like experience with another group that inspired Capital Alliance just in a different domain. And now I've been in that group for 8 years, and if I look back, I couldn't have imagined all the good things that came from these relationships. I wouldn't have even known that I would have formed those relationships. It was just a matter of showing up, engaging, being open, and like, because it's in a domain that I don't really spend most of my time in, that, whereas I do spend most of my time in investing and fund management. That's kind of what inspired the creation of Capital Alliance. So so I think we're at the end of the broadcast. Any last words? And if people were intrigued or want to reach out or follow up, I know you guys you have room for new investors as well. So how does somebody get in touch?
I guess the first step would be subscribe to the podcast. It's called Telltales. We're on every single Wednesday. And then we also publish our partnership letters every quarter. And you can get those by subscribing on the website. They tend to go out quite a bit later than they go to partners, but we just sent out the Q1 letter. And if you go sign up on the website, we'll send that to you right away. And to start a conversation. I think our goal with new investors is to find people that understand what we do and are well aligned, because this is a long-term game. So we like to play these long-term games with long-term people. And so as a result, as Ken knows, we don't really try to do sales. It's more about developing relationships with people who think similarly long-term.
Yeah, couldn't have said it better. You want to add anything, Charlie Munger?
No, I think Mike said it. It's just reach out to us. We're available. We enjoy talking to our LPs and anyone interested, about these topics. Like we just had the conversation with you.
Great. Well, I've always been super impressed with how thoughtful you guys are. Love Telltales. Try to catch it whenever I can, and look forward to seeing where things go from here.
Cool.
Yeah. Appreciate it, Ken.
Yeah, thank you.
Thanks for watching this episode. Click the screen to catch our past episodes with Asif Surya and Matthew Peterson. And to apply for the Capital Alliance Mastermind, hit the first link in the description.